and I was, part of an institutional bank many years ago. When you go to those places, the traders on those desks only trade one or two or maybe three instruments. And when things get quiet, they don't go, well, I'm going to go trade Bitcoin today. No, your boss won't let you do that.
Welcome back everyone to MC now with David Floyd from Aspen Trading. We spoke a long time ago, like 5 years ago. So how's it going, David? Welcome back.
Hey, thanks a lot, Etienne, and congrats on your success with your podcast.
Awesome, I appreciate it. So we got to catch up. Tell me what's been going on since the past 5 years we spoke. What's new? What's been going on?
Well, I think there's a lot new and there's a lot that's not new. As we were talking a little bit before going on camera, trading doesn't change a whole lot. Professional traders have a game plan, they execute it each day, and the markets change. The traders don't necessarily change, but the markets change. But I think the main thing that's changed for me is I've kind of evolved past more of an Elliott wave foundation, which I did for years. And I just started getting to the point where I liked it. It was working, but I felt there was still too much subjectivity to it. Even though Elliott wave has objective rules, they sometimes get applied subjectively. So I started about probably about 2.5 years ago, going on a quest for something that was more objective, that didn't require my input per se, just the collection of data and calculating the data to come up with technical levels that I thought would be relevant. So that's probably been the biggest thing for me, is that I've gone to a very objective trading style using support and resistance levels that I have had calculated versus, I'm going to draw them on a line across a swing high and a swing low, because again, that's subjective. And the problem with doing it that way is you need to make sure that everybody else in the marketplace sees those levels as relevant too, and they may or may not. And more times than not, they're not going to see them. So that's been the biggest change, and it's been a real game changer for me. It's made less analysis time, because I'm not doing the analysis. I'm just looking at where the levels are, and then I'm factoring in basic trading strategies that you develop over time. So that's been the big thing, and I'm glad I did it. It's where I want to be positioned for the foreseeable future.
That's very interesting, because I did the same sort of shift in the past few years, actually the past 2 years or so, not with Elliott wave at all, but with support resistance areas, with having them drawn on the chart by yourself, which is very kind of systematic, but kind of also discretionary at the same time. You can screw up, you can do them differently from other people, versus having things that are more calculated into algo. Now, I'm very curious to know how you calculate these support resistance areas.
Well, I won't go into all the details, but I'm happy to share kind of the general idea here. As I said, I was looking for something that would be recognized by and large by the market, by enough people in the market. So the only way to do something like that has to be based on volume, has to be based on trade frequency, and it has to be based on time. So using those three principal factors, I came up with an equation basically that would identify these prices or these levels. And I calculate 4 levels, or four channels, because each category has an upper limit and a lower limit. So basically a band. And it's designed for shorter term traders, medium to long, and then longer term. And so obviously the relevance goes up in terms of the frequency of the calculations. So what I basically use them for is that when prices are above or below those bands, they act as support or resistance until proven otherwise. And given the fact that it is based on volume, time, frequency, oftentimes when the prices get to those levels, the market has a reaction to them. If it's approaching a resistance level, oftentimes prices will stall and maybe reverse. So, whether you're day trading or portfolio investing, the levels are relevant. Obviously, the longer term levels are going to be more relevant for a longer term investor, and the prices won't come and interact with those very often, because those are levels that tend to be very wide apart. But the shorter term levels, intraday traders will interact with those day in and day out. And It's primarily what I use, when I'm doing my intraday trading as well as my swing trading.
Awesome. Interesting for sure. So you're able to see these with the volume, which I didn't really think about that much when I look at my own zones. Now, how is that different from, let's say, because you could use something that's already out there, like pivot points, like maybe some channels. How is that different from what you've built for yourself?
Well, the main difference is that it's like, again, I'm not going to go into all the details of how they run the equation, but again, channels and the typical things that get drawn on charts usually are based on swing highs or swing lows, or subjective drawing of a trend line. You're connecting a swing high, you're connecting a top to a bottom. Again, I'm not saying that can't be effective, but again, that's you, or let's say the algorithm, looking at price bars and going, I'm going to connect those price bars and draw a trend line above, and I'm going to draw a trend line below and create a channel. And that's fine. It may work really well. It may help identify like a flag pattern or a consolidation pattern that then breaks. But again, my argument with that is that, one, most people in the marketplace need to be seeing that same thing and be collectively interested in it as well. And that may not be the case. The only way to know that people buy, a large number of people, whether it be institutional traders, retail traders, it doesn't really matter. The only way to know if a lot of people are looking at a level is to know what the volume was, the trade frequency, and the time duration. That's the only way you can kind of know, like, wow, that level right there meets all the requirements of the three categories I just gave. Therefore, we know a lot of people are looking at that level because they executed trades at that level, whether they be bullish trades or bearish trades. It doesn't matter. If the S&P's at, let's say, 43.67 comes up as one of the, let's say, a resistance line intraday, I'd be willing to bet that prices will interact with that level. Maybe they reverse and go lower, maybe they pause and then break higher. But the fact of the matter is the levels will get hit. The market will definitely, pause and react to it in some way. And then it's our job as traders to say, what's the tone of the market right now? Is this resistance level going to hold, or are we going to break through and invalidate it and start to become more bullish? I was going to say, sometime if we want, I can easily show them on my screen just from a visual. It might give a better sense of what they look like. They, might be confusing at first, but you can see how the striations will usually impact prices. Okay, so obviously we're calculating these levels based on daily data. You can run them on intraday charts too, but given that intraday charts don't capture all of the data going back, the levels, they'll be pretty much spot on. But I always take my cues from the daily chart, and if I'm executing on intraday, I'll just make note of the levels on those intraday charts. But again, there's four sets of bands, and I color code them in levels of significance. So the green band, they're all significant, but the green band is the shortest term band. Then we go to an orange one, then we go to red, and then we go to purple. Purple is the biggest one. Like I said, most markets aren't going to interact with the longer term bands very often, but they're going to interact with the shorter term bands because they're going to be more recently around current price action. So here's the S&Ps. It's a market that I trade very actively during the day. And again, this is a daily chart. So the green band is the current, the most current support and resistance level that we're looking at. Now you can see that since the beginning of the week, they've been broken down pretty hard. We've been below 43.67 all week. So that level is no longer relevant until we rally back up there. If we were to rally back up there, then we might consider that a resistance level. Maybe we get short. But given the fact that that was at 43.67, we're at 41.93. If the market goes all the way back there, that's probably not going to be a good short because the market's moved a lot, and we're probably in a slightly different momentum. We might be in a more bullish mode. So that's what we have to factor in. Again, you don't want to just blindly buy and sell based on these levels. So let me just put in the other longer term ones now. So, for today, the big break today or yesterday was the break below 42.66, which is this orange band. And you can see we've interacted with that, a few times over the last year, and each time it had been supportive. This time, not so much. So that to me is definitely what I would call, there's definitely a change. The momentum is clearly shifted negative. I mean, you could have made that argument up here as well. But relative to this particular band, it's the lower orange band, the upper orange band is up here. The general game plan is that, obviously rallies towards 42, what's that level? 42.67 should be shorted. And certainly when we, if you drop this down to an intraday chart, once we broke below 42.67, there was definitely little rallies that you could have shorted, to take advantage of that new shift from more of a bearish bias to a really bearish bias. So you're always thinking of things relative to the band. So for instance, when you hold the lower level of a band, you expect prices to rally and go all the way to the other side of the band, which eventually it did, but not a straight shot. So bottom line is, they're not foolproof. Nothing in technical analysis and nothing in trading is foolproof. All I'm interested in is I want to know about the levels where the market's going to react. And if the market's reacting in the way that the tape is weak, or let's say the tape is strong, then I know that's an area that I can execute trades from. That's all these levels are really providing. They're providing me an area where the market's going to react and allowing me to kind of capture an ideal inflection point. And, they've worked extremely well, extremely well.
I'm curious, how do you trade at these zones or these bands? Do you have one particular trade you'd like to focus on, or is it like a mix of different things based on how the market reacts? What's your go-to trade whenever you hit those areas?
Well, let me do this. Like I said, these are always calculated based on the daily charts. And what I do for simplicity's sake is I oftentimes will transpose these levels onto an intraday chart, because I do intraday trading on the S&P. So let's look at that. And I'm taking many of these levels directly from the daily chart and putting them onto an intraday chart, in this case, a 30-minute chart. But I'm going to drop this down to a 15-minute. Coming into yesterday, we knew that 43.05, which is right here, was a really, really key support level. So you asked how I'm trading this. Well, oddly enough, coming into today's session, I was kind of bullish, because yesterday, which would have been Tuesday, we broke down below 43.05, which of course was bearish. But by the end of the day, we'd managed to climb back above 43.05 and spent most of the overnight session meandering higher, albeit not in a very decisive way. But the fact that we got back above 43.05, that to me was bullish. I was long, looking for a likely move from one end of the band to the other end of the band, which would have been 43.70. That was what was on my mind coming into the New York session today. We were long at 43.22. I was expecting things to go up towards 43.70. Well, that didn't happen. We kind of flamed out early on in the New York session. And this was the key thing that again, these bands or these levels provide, is that we broke back below 43.05. I didn't get short this break because, as I always tell clients, support is support until proven otherwise. So I'm not blindly selling breaks of these bands. I like to sell a break and then a retest, which ultimately we got, which was kind of weird, because we went from 43.05 all the way down to 42.67, and then we came all the way back. And what did we do? We kissed it at 43.05. I think 43.05.50 was the high. I got short at 43.03.50. And then the market continued to tank. I wish I could tell you that I was in for this whole move. No, I wasn't, but I caught a good chunk of it. So again, it's what's the recency of the way the market's interacted with that level? Are we moving lower and it broke and then retested? Okay, I want to short it. So of course, sometimes you're going to be wrong, but that's, taking it from the big levels, transposing them onto an intraday chart, and using those levels to navigate the intraday ups and downs. And, obviously, as you can see in the S&P, there's plenty of range these days, and there's plenty of room to get these big moves, but you got to know the levels that the market is going to react from. And in this case, 43.05. Now, You and I are doing this on Wednesday, the 23rd. And, this is live data right now. There's nothing below us here. There's no support for a long way down based on my levels. So I've kind of got nothing to work with right now. Yeah, we might rally all the way back to, let's say, 42.63, which is a key level. But again, if we rally all the way back there, do I really want to be getting short? Maybe I do. I'll kind of decide at that point in time. But what I do know will happen is prices, if they do rally back up to 42.63, they'll definitely fart around up here. They're not just going to blow right through it, and they might just kiss it and then roll back off. So again, I don't want to make an assessment of, leaving limit orders out there at this point. I want to wait for prices to get up there and take the temperature of the market at that time. So hopefully that kind of crystallized it a little bit more.
Very interesting. So how do you trade a market where you have no zones? Do you just sit and wait for zones to appear and to show up, or do you just kind of, you have a way of trading that and look at the trend?
Yeah, I'll probably be pretty light on trading, at least in the S&Ps. There's other markets where we're coming into some levels. 10-year notes, for instance, we're above 126.12. In fact, I can show you 10-year notes. They might be ready to pop a little bit here. So let's take a look at 10-year notes. These ones, this will come up really clear. So again, we've got daily data right here. We've got the green band down here. We held the lower part of the green band, and now we're trying to get back above it, which is at 126.13. If we can get back above 126.13, I think we got room to go to 127.10. Again, not a massive trade, but almost a full point. So, not a bad trade for one contract, two contracts, whatever you're trading. But we got to get back above that 126.13, because remember, resistance is resistance until proven otherwise. And right now, prices are trying to get back above it. But, I don't know when this will be posted. It'll probably be posted, long after this trade sets up. But for those of you watching it, a week or so later or a few days later, it'd be really interesting to see what happens. Do we get through 126.13? And if we do we traverse to 127.10 or maybe even a little bit higher? Certainly notes are long overdue for a bounce. We just haven't had one. So yeah, in the S&Ps, I probably don't have much to work with tomorrow, but I do have something to work with in 10-year notes. FX right now, not a lot going there. There was a good move above some levels in Aussie dollar and Kiwi dollar a couple of days ago, but those moves have kind of extinguished themselves at this point.
I'm sure people are going to want to ask, how do you know when a zone is going to produce like a reversal or break of the zone? Like you mentioned, the resistance is still there, still valid until proven wrong. But how do you know when that's wrong? And how do you know when you have to move on to a different kind of trading?
Well, typically I'm not going to be buying, ahead of that. I'm not going to be anticipating that breakout because I've seen it happen too many times. It's okay to wait, let the market confirm it wants to move above that level and then try to buy a modest pullback. Maybe prices like they did here, they pushed higher. They tagged 127.10. I can expand this a little bit if it would help. That'll help your viewers a little bit. We did break above 127.10 and we tagged 126.14, 126.13, and we did move all the way. So, I'm never trying to buy here going, wow, that's a pretty bullish candle. I'm pretty sure we're going to break above that. I wait for prices to break above, pause, maybe pull back a little bit, then get long, because once they break above and hold, that tells me that the market's accepted above that level. Now, sometimes it just goes right back in, but you're keeping your stop pretty tight because once we go back below here, that's telling you it's not ready to break out. So you got a relatively minor stop loss relative to what your upside potential is. So for right now, yeah, this looks like it wants to move higher, but I'm not going to go long until we break above and pull back a little bit. And it looks as though we're not getting a lot of selling pressure on the way back down. I'll take a stab at it then and hope that the momentum has shifted. But you know how it is in trading. You have to take the setup that looks good. You never know what the outcome is going to be. And you keep your losses to a minimum and you try to stay in your winners. So you keep your expectancy and your risk reward, in really good standing over time. But that's how I advise my clients. And that's how I advise myself. Don't try to get ahead of it. Don't try to be too cute, because many times I've done it in the past. We all make mistakes. We're humans. I'll try to anticipate a break and it doesn't happen and I'm long and I'm like, that was really dumb. I just wait. I try to do my best to wait. Yes, you're going to give up a few ticks or a few points if you're trading stocks, but I'd rather know that the market's accepted above that level before I get long or short if it's going down.
This is something else you hear a lot online. The fact that people say, "Oh, you got to follow the trend. You got to trade with the trend." The fact here, for example, that the market's been decreasing for a long time, would that be a case of only going short for you, or does that not matter at all?
No, I'm glad you actually asked that. I used to be such a a stickler for trying to trade in the direction of the trend, and I still think that's a decent idea. Don't get me wrong, but there's oftentimes a lot of opportunities that are counter trend, and this might be one of them. Like you said, we haven't had that many. I mean, 10-year notes have been pretty much in a straight line down since the beginning of the year. We've had a couple of bounces, but man, they've been modest. And this one may not even end up developing. But if this one develops and it gets a little legs, that's probably got more potential to move higher than getting short from here, because we've moved lower for an extended period of time. Again, it doesn't mean we can't continue to move lower, but odds would favor a more of a spring higher in a quick, decisive move, given how much the market's moved lower. So that's why it's really key to let the market tip its hat. Let it get above 126.13, 126.14, hold, and then I'll buy the pullback. And if it doesn't work, you know where my stop loss is? Like maybe 126.10. So I'm risking 8 ticks, maybe 10. That's not a lot, but my upside's probably 20 or 30 ticks. I love that risk reward.
Awesome. How have you seen the market evolve over the past 5 years? Has something's changed, or is it still the same? Do you still trade the same way, or are things different in the market compared to what it was a couple of years ago?
I would say up until the beginning of this year, the market had changed in terms of just being in a constant grind higher, which I thought was, it was what you couldn't argue with it, but it was just insane. Every dip was bought, every single dip was bought. We just continued to go higher and higher. So the volatility was it was nothing. It wasn't really a trader's market. You were rewarded for buying every pullback, whether you were sloppy or, spot on. So, I think in the last 5 years, we've just been in a market where everything marches higher. And I think that can lead to a lot of complacency among newer traders. And I think they're learning those lessons right now. I happen to love the way the market's been trading since the beginning of the year. But has anything fundamentally changed? I don't think so. Everybody says, the algorithms and everything have taken over, and, they're definitely out there, no doubt. But I'm still kind of the mindset that algorithms, unless you're at the most advanced level at massive hedge funds or massive institutions that have not only the capital, but the educational firepower to create algorithms, I still think trading is by and large a human endeavor. And our brains are still much better at picking up nuance. So, despite the machines being in the marketplace, as they clearly are, I'm still able to go in there and carve out a living. And I know, many of my colleagues are also doing it. Our approaches may be slightly different, but, things don't change. There's fear and greed. Prices move up, prices move down. The market leaves its, footprints or breadcrumbs, which is what I'm trying to do with my levels, trying to identify areas where the market's going to react. That hasn't changed. Now, all we have right now is we have a market that's actually moving in a different direction, and that's causing a lot of turmoil for people who've only known one thing, which is to buy the dip. And traders have to be flexible. You got to be able to short, and you got to be able to go long. And if you can't do both of those, you really can't last in this game.
What would be your advice for traders who only have known bull market? They're used to just buying things that go up pretty fast after. How would you tell them to adapt to what they have right now?
Well, you're gonna have to become more of it. You're actually gonna have to become an actual trader. Buying the pullback, based on, very simple strategies. That's not really trading per se. it works. Again, I'm not going to discount anybody's success. It obviously worked, but that's not a long-term strategy. That's not going to get you through a period like this. So what I would suggest people do is learn the basics of trading. The most important thing you can learn, and it's easy to do, is only focus on a few instruments to trade. Trading is not a game of looking to where the hot thing is on any given day. There is a level of intimacy you can develop with the instruments you trade. I know that sounds a little weird, but it's not. Every instrument has its own personality in terms of the way it trades. And I think it's our job as traders to have a handful of instruments that you trade and know very well. I can offer no better explanation than this. I've been in this industry a long time, so I know a lot of retail clients. I know a lot of institutional clients. And I've got some clients at, some pretty big institutional firms. And I was, part of an institutional bank many, many years ago. When you go to those places, the traders on those desks only trade one or two or maybe three instruments. And when things get quiet, they don't go, well, I'm going to go trade Bitcoin today. No, your boss won't let you do that. You're the dollar yen trader. You're the, you're the S&P trader. You're the 10-year note trader. You're the interest rate arb trader. You specialize. Retail traders shouldn't do anything different than that. For me, here's what I trade. S&P 500. I trade it very actively during the day. Sometimes I'll swing trade it. I trade 10-year notes, swing trade them. And then 2 or 3 currency pairs that I swing trade. That's it. That's more than enough to keep me busy and challenged in terms of trying to keep track of everything. I'm not, when things get boring, like you asked me, I've got nothing probably to do tomorrow in the S&Ps, at least as of now, unless something changes. That doesn't mean I'm like, well, okay, I'm going to go trade the NASDAQ today. I'd be a fool. I don't know the rhythm of the NASDAQ. Sure, I can pull up all the levels on my charts, but that's not really going to provide me much of an edge to someone who trades the NASDAQ every day. That person's going to eat my lunch. So it's so important. And I think for people, they've got the, the shiny object syndrome or the squirrel syndrome. If things are boring in what you're doing, I'm going to go over and do that. Well, I got news for you. That won't work in the long run. That will not work. That's like, telling your attorney, or seeing your attorney go, I don't have a big caseload today, so I'm going to go over and learn how to be a plumber. No, they stick with their job. We're traders. We stick with what we know.
That's a really good lesson. That's really cool. So it's really about finding your sweet spot, finding what you're good at, and just sticking to that. Now, how do you pick which market to focus on as a retail trader? Is it just experience? Like, is it just what you're good at, or are there some things people have to consider regarding what market they trade?
I don't really think it matters. I just think you have to choose some markets that you like to trade. I happen to like FX. I happen to like futures. But if you told me that, hey, I just want to trade Tesla, ARK, and I don't know, Bitcoin. I'm like, oh, okay, cool. Just trade those. Analyze those every single day. You'll figure out the rhythm and what to do. So I don't think it really matters. It's a question of stay in your lane. Stay in your lane. And again, if the biggest hedge funds in the world, I'll give you a complete example. Citadel. I have a couple of their traders as clients in London. Those guys and gals on that desk only trade a handful of instruments. They never deviate. So I have the best example of telling you how to stay disciplined is if the guys and gals at Citadel can't trade more than 2 or 3 instruments, why on earth should you be? Those people are at the top of their game. They are at the top of the food chain. And if they're not trading everything under the sun, then you shouldn't be either. And I don't mean you yourself personally, but your viewers. There's nothing wrong with going in and doing the same thing every day. Remember, this is a job. You're doing this to get paid. And anybody who tells you anything differently is not telling you the truth. People only trade to make money. Hopefully it's enjoyable, but we do it to make money. And the only way you're going to make money is if you treat it like a job. You show up and you do the same thing day in, day out, but it's not boring. I can tell you that even when markets get boring, it's not boring. You're still looking for those trades. It's the best job in the world.
What would you tell someone who's focused now on Forex only, and with the market now, they don't have many things to trade, many moves? Should they just kind of learn to make it work in Forex? Should they kind of learn to trade maybe smaller moves? Or is there like maybe one or two markets that could add to it to be able to kind of find more opportunities that are kind of well suited for Forex?
Well, I think it's a great question. I mean, I've been in the FX industry a long time, and you as well. I mean, let's face it, volatility's collapsed, and it's not what it used to be. Now, at some point, it might become volatile again. So yeah, this is a good kind of exception to the rule. Trade, the same instruments day in and day out. But at some point, you have to be like, you know what, these instruments just aren't trading very well anymore. That doesn't mean you can't go look at other instruments. It means you're looking at other instruments and then trying to adopt those into your repertoire. It's not about looking at an instrument one day and then moving to a different one the next day. That's a no-go. But if you've been trading FX for a while and you're just kind of frustrated with the lack of moves, is it okay to take the way you trade Forex and try to overlay it onto another market? Yeah, of course it is. There's going to be a learning curve, but just stick with it. Go to a market that's more volatile. I mean, the S&Ps right now, wow, volatility out out your ears. So that might be a little bit unfair. If you're not used to that volatility, it's going to, knock you around quite a bit. But yeah, at some point you have to look at the markets you're trading and go, wow, just not getting the return I used to. Maybe I need to go look at some different markets, and that's okay. Just know that you're going to have to go through a learning curve.
Speaking of learning curve, how can someone learn a different market? Is it just like screen time every day, looking at the market, how it behaves, or maybe some backtesting, looking back at past data? How can they kind of improve their game in different markets?
Yeah, I think the most practical answer is, screen time. I mean, yes, go back and look at charts and see how things have moved. But again, that's looking back in time. And yes, it will be relevant. Don't get me wrong. But I think the best thing to do overall, I'm just going to minimize this so I won't blast that out. The best thing to do is just start watching the market. Again, overlay your approach onto that market, see how the market reacts to it, and just basically, start to get in the rhythm with it. It's going to take time. The market's not going to trade dramatically different than, let's say, Forex. It's just going to be a little bit more active, but you're going to pick up on the finer points. So yeah, like anything, it's going to take a little time. And some people don't want to hear that, but you can't get good at something just by showing up. You got to put in the time.
Awesome. Well, this was really awesome advice, and I appreciate your time and your thoughts on this. What can people find you if they want to connect with you or reach out after the interview here?
I'm sorry, that last part
Find you
again?
or connect with you after the interview.
Oh, sure. Well, you can find me at my website, which is aspentrading.com, like ASPEN, like the town in Colorado, aspentrading.com. I'm also on Twitter at aspentrading10. But the best way to get me is, go to my website. You'll see that you can get the levels. They're available on TradingView as well as MotiveWave. And if you want my thoughts on the market, I provide a newsletter each morning to my clients, letting them know how I plan to deploy my trades based on my levels. And so if you want to kind of have a little bit of guidance, but that's the easiest way to get a hold of me. And feel free to reach out. I'd love to hear from people.
Thank you, Dave, for your time. I appreciate your advice and your thoughts, of course. This was really good. I think people will like it and will really enjoy it. I want you guys to let us know your thoughts in the comment section, of course, on YouTube. We'll put all the links for you to check out Dave right there on his website, Aspen Trading. And Dave, I hope we catch up soon. I hope we talk to you soon.
That sounds great, Etienne. You have a great evening, and thank you very much for having me on.